Welcome, and thank you for joining our 2022 second half equity income outlook. Today we highlight the equity investing for a high inflation environment. My name is Ruairi Finlayson, or Ru for short, and I'm a fund manager here at Aberdeen. I'm here to talk to you about equity income investing and why we think it works, particularly in times of high inflation. There's a few reasons behind this, which we'll get into. But first, perhaps it's worth reminding ourselves where we are on the inflation front. As I'm sure you know, inflation has been rising globally and GDP expectations have fallen as a result. This picture is substantially worse in developed markets, inflation rates hitting 9.1% in the US, 8.6% in Europe, 9.4% in the UK, numbers not seen since the 1970s. Indeed, we are now being warned of double-digit inflation here in the UK, which may or may not come to pass. So what can we do about it? Unlike a number of other asset classes, equities have the ability to grow both your capital and your income at a rate above inflation over the long run. Indeed, the most recent estimates suggest dividend growth of about 13% year on year, which is compelling, even against those high inflation rates. So how do equities actually achieve this? Well, for example, when strong companies increase their prices for their goods and services above the rate of inflation and they control their costs, they're able to grow their profits and the cash flows ahead of inflation. With those cash flows, they are able to reinvest in their businesses, buy back their own shares, or pay out dividends. And indeed, the very best companies can do all three. As shareholders in those companies, we can benefit from this in the form of higher prices, share prices, as they compound on higher earnings, as well as from dividend growth, outpacing inflation over the long run. But it's also a relative game. During times of higher than expected inflation, such as now, we often see the share prices of highly valued, unprofitable companies, share prices compress, and dividend-paying companies outperform, as we have seen this year. Here are a number of long-term stats using the S&P 500 as an example. Since 1970, companies with higher dividends or high dividend growth have both outperformed during periods of high inflation. And during the 1970s themselves, which we all know was a period of high inflation, the vast majority of total returns delivered by the index came from dividends and dividends reinvested, rather than from price appreciation. But that period isn't completely unusual in terms of a large percentage of returns coming from dividends. It's just that it gets supercharged during the periods of high inflation and also importantly, during periods of economic stress. So what's next for the economy and the outlook for equity markets? Well, the equity markets have derated to a certain extent on the back of rising interest rates. There's been a further derating on the back of geopolitical risk, as well as economic worries to come, due in part to the level of inflation and rising interest rates. We certainly don't think we're out of the woods yet, and we fully appreciate there's a reasonable chance of global recession sometime in the next couple of years. However, we do believe that equity income is relatively well placed, given the comparatively steady income stream that dividends can provide. This is often reflected in the relatively steady performance of dividend-paying stocks during these times. We hold a number of beliefs regarding equity income investing here at Aberdeen. Firstly, we believe in providing a premium yield above the markets to our fund holders on a consistent long-term basis. To do so, we target sustainable and growing income streams from a wide selection of companies across sectors and geographies to increase the diversification of those income streams. Secondly, we're not interested in yield for yield's sake. Instead, we target a total return and source our dividends from across the yield spectrum to give balance to our portfolios. We may own companies that yield less than 1%, and some companies that yield more than 10%, and everything in between. This makes us less reliant on high-yielding companies and becomes particularly important in times of great economic stress. Thirdly, a deep understanding of our portfolio companies is essential in determining their current state and their prospects for the future. We believe that cash is king and is more important than accounting profits. Strong free cash flow generation in the future is key to maintaining and growing dividends. So to summarize, we believe that equity income is the ideal solution to target both income today and capital appreciation tomorrow, resulting in inflation-protected returns over the long run. Thank you again for viewing our 2022 second half equity income outlook. We look forward to having you join our next webcast. Thank you.